Question 1. Which of the following statements is true regarding common stock? A. Common stock typically offers fixed dividend payments. B. Common stock shareholders have a residual claim to assets in a liquidation. C. Common stock is a debt instrument representing a loan to the company. D. Common stock shareholders do not have voting rights. Answer: B. Common stock shareholders have a residual claim to assets in a liquidation. Common stock represents ownership in a company, and while it does not guarantee fixed dividends, its holders have the right to vote on corporate matters and a residual claim to assets in a liquidation, meaning they are paid after bondholders and preferred stockholders. This residual claim emphasizes that common stockholders assume the most risk but also have the most potential for capital appreciation if the company succeeds. Think of it as being last in line to get paid if the company goes out of business, but first in line to benefit if it thrives. Always remember that common stock offers growth potential and voting rights, distinguishing it from debt securities. Question 2. A registered representative, RR, receives a complaint from a customer regarding a transaction. Under FINRA rules, what is the RR's primary responsibility with this complaint? A. Attempt to resolve the complaint directly with the customer. B. Forward the complaint immediately to their supervisor or principal. C. File the complaint directly with FINRA. D. Ignore the complaint unless it is written and formally submitted. Answer: B. Forward the complaint immediately to their supervisor or principal. When a registered representative receives any customer complaint, whether written or oral, their primary responsibility is to escalate it immediately to their supervisor or principal. This ensures that the firm can properly log, investigate, and address the complaint in accordance with regulatory requirements and firm policies. Simply put, don't try to fix it yourself, let the proper channels handle it to ensure compliance. Remember, timely reporting of customer complaints is crucial for maintaining regulatory integrity and protecting both the firm and the customer. Question 3. A married couple opens a brokerage account as joint tenants with right of survivorship, STROs. If one spouse dies, what happens to the assets in the account? A. The deceased spouse's share passes to their estate, subject to probate. B. The surviving spouse automatically becomes the sole owner of the account. C. The account is frozen until a court order dictates distribution. D. The assets are split equally between the surviving spouse and the deceased spouse's heirs. Answer: B. The surviving spouse automatically becomes the sole owner of the account. In a joint tenants with right of survivorship, STROs, account, ownership is shared equally, and upon the death of one account holder, the surviving account holder automatically receives the deceased's share, bypassing probate. This means the assets immediately pass to the survivor without needing to go through the legal process of settling an estate. This account type is popular for its simplicity in transferring assets upon death, as seen with couples who want their partner to directly inherit the account. Think of STROs as a seamless transfer of ownership to the survivor. Question 4. An investor places an order to buy 100 shares of XYZ stock at market. This order will be executed. A. Only if the stock reaches a specified price or better. B. Immediately at the best available price. C. At the closing price of the trading day. D. At a predetermined price set by the investor, regardless of market conditions. Answer: B. Immediately at the best available price. A market order is an instruction to buy or sell a security immediately at the best price available in the market. This means the order will be filled as quickly as possible, ensuring execution but not guaranteeing a specific price. For example, if you place a market order to buy, you will pay the lowest current offer price. Conversely, if you place a market order to sell, you will receive the highest current bid price. Remember that market orders prioritize execution speed over price certainty. Question 5. An associated person uses confidential information obtained through their employment to trade securities for personal gain. This action is considered A. A standard practice within the securities industry. B. A violation of the insider trading rules. C. Acceptable if the gains are reported to the firm. D. Permissible as long as the information is not widely known. Answer: B. A violation of the insider trading rules. Trading securities based on material, non-public information that could affect a company's stock price and is not available to the general public, is known as insider trading and is strictly prohibited. This practice is illegal because it provides an unfair advantage to those with access to privileged information, undermining the fairness and integrity of the securities markets. For instance, knowing a company is about to announce a major acquisition before it's public and buying shares based on that knowledge is insider trading. Always remember that fairness and equal access to information are fundamental to market integrity. Question 6. Which of the following characteristics is true of cumulative preferred stock? A. It has voting rights similar to common stock. B. It allows investors to convert shares into common stock. C. It accrues unpaid dividends that must be paid before common stockholders receive dividends. D. Its dividend payments fluctuate based on the company's earnings. Answer: C. It accrues unpaid dividends that must be paid before common stockholders receive dividends. Cumulative preferred stock is a type of preferred stock where any missed dividend payments accumulate and must be paid to cumulative preferred shareholders before any dividends can be paid to common stockholders. This feature provides an added layer of security for investors, ensuring they eventually receive all their promised dividends. For example, if a company skips 2 dividend payments, those payments become arrears that must be settled with cumulative preferred shareholders before common stockholders see any distributions. Think of the cumulative aspect as a built-in IOU for dividends. Question 7. How would an increase in the Consumer Price Index, CPI, likely affect the value of existing fixed-income securities, such as bonds? A. Their value would likely increase due to higher interest rates. B. Their value would likely decrease due to higher interest rates. C. Their value would remain unchanged, as bonds are not affected by inflation. D. Their value would increase due to increased demand for fixed payments. Answer: B. Their value would likely decrease due to higher interest rates. An increase in the Consumer Price Index, CPI, indicates inflation, which often leads the Federal Reserve to raise interest rates to cool down the economy. When new bonds are issued with higher interest rates, existing fixed-income securities, which pay a lower, fixed coupon rate, become less attractive to investors. This decreased attractiveness drives down the market value of older bonds. For example, if your bond pays 3% and new bonds pay 5% due to rising rates, your 3% bond is less desirable. Remember, bond prices move inversely to interest rates. Question 8. Under the Uniform Gifts to Minors Act, UGMA, or Uniform Transfers to Minors Act, UTMA, accounts, who is responsible for paying taxes on the income generated by the account? A. The custodian of the account. B. The minor. C. The donor of the funds. D. The broker-dealer holding the account. Answer: B. The minor. In UGMA/UTMA accounts, any income or capital gains generated by the investments within the account are considered the property of the minor, and therefore, the minor is responsible for paying the taxes on that income. Although the custodian manages the account, the assets legally belong to the minor. However, tax implications for minors can be complex due to the kiddie tax rules, which may tax a portion of the minor's unearned income at the parent's higher tax rate above a certain threshold. It is important to remember that the income generated by the assets in a UGMA/UTMA account is taxable to the minor, not the custodian. Question 9. Which regulatory body is responsible for regulating municipal securities, including developing rules for municipal securities brokers and dealers? A. The Securities and Exchange Commission, SEC. B. The Financial Industry Regulatory Authority, FINRA. C. The Municipal Securities Rulemaking Board, MSRB. D. The Federal Reserve Board, FRB. Answer, C. The Municipal Securities Rulemaking Board, MSRB. The Municipal Securities Rulemaking Board, MSRB, is a self-regulatory organization, SRO, specifically tasked with creating rules for municipal securities firms and professionals involved in the municipal bond market. While the SEC oversees the MSRB itself writes the rules that regulate the conduct of broker-dealers and banks that engage in municipal securities activities. For instance, the MSRB sets rules on fair practice and professional qualifications for those dealing in municipal bonds. Always remember that the MSRB focuses exclusively on the municipal securities market. Question 10. A key difference between an open-end management company, mutual fund, and a closed-end management company is that A. Open-end funds trade on exchanges, while closed-end funds are redeemed by the fund. B. Closed-end funds are continually offering new shares, while open-end funds have a fixed number of shares. C. Open-end funds are priced at net asset value, NAV, while closed-end funds can trade at a premium or discount to NAV. D. Closed-end funds can only invest in debt securities, while open-end funds can invest in both stocks and bonds. Answer, C. Open-end funds are priced at net asset value, NAV, while closed-end funds can trade at a premium or discount to NAV. Open-end funds, commonly known as mutual funds, continuously issue and redeem shares, and their purchase and redemption price is always based on their net asset value, NAV, per share. In contrast, closed-end funds issue a fixed number of shares through an initial public offering, IPO, and then trade like regular stocks on exchanges, meaning their market price can deviate from their NAV and trade at either a premium, above NAV, or a discount, below NAV. Think of a closed-end fund's shares as a stock that you buy and sell in the open market, while mutual fund shares are directly bought from or sold back to the fund itself. This distinction in pricing mechanism is fundamental. Question 11. Which type of risk affects a specific company or industry, but not necessarily the entire market? A. Systematic risk. B. Interest rate risk. C. Unsystematic risk. D. Purchasing power risk. Answer, C. Unsystematic risk. Unsystematic risk, also known as specific risk or company-specific risk, is the risk associated with a particular company or industry. This type of risk can often be reduced or eliminated through diversification, such as by investing in a variety of companies across different sectors. For example, a new competitor entering the market might negatively impact a single company's stock, but not the overall stock market. In contrast, systematic risk affects the entire market and cannot be diversified away. Question 12. Which of the following is primarily an interdealer market where unlisted securities are traded? A. The New York Stock Exchange, NYSE. B. The Nasdaq Global Select Market. C. The over-the-counter, OTC, market. D. The Chicago Board Options Exchange, CBOE. Answer, C. The over-the-counter, OTC, market. The over-the-counter, OTC, market is a decentralized market where securities not listed on major exchanges are traded directly between dealers through electronic networks. Unlike exchange-based trading, the OTC market does not have a physical location. Instead, participants trade via phone and computer networks. This market primarily facilitates the trading of unlisted stocks, corporate bonds, and municipal bonds, acting as an interdealer network where prices are negotiated. For example, penny stocks are often traded exclusively on the OTC market. Question 13. A firm's website, which is accessible to current and prospective customers, would be considered what type of communication under FINRA rules? A. Correspondence. B. Institutional communication. C. Retail communication. D. Public appearance. Answer, C. Retail communication. Under FINRA rules, retail communication is defined as any written, including electronic, communication distributed or made available to more than 25 retail investors within any 30 calendar day period. A firm's website clearly fits this definition as it is designed to reach a broad audience of individual investors, both current and prospective. Because it reaches a large retail audience, retail communication often requires principal approval before use to ensure accuracy and compliance with advertising standards. Think of any mass communication to the general public as retail communication, requiring careful review. Question 14. An exchange-traded note, ETN, is a type of unsecured debt security. This means that A. ETNs offer principal protection and are guaranteed by a government entity. B. The ETN's performance is tied to an underlying index, but the investor faces the credit risk of the issuer. C. ETNs are always backed by a diversified portfolio of assets. D. ETNs pay a fixed interest rate regardless of the underlying index performance. Answer: B. The ETN's performance is tied to an underlying index, but the investor faces the credit risk of the issuer. An exchange-traded note, ETN, is an unsecured debt obligation issued by a financial institution, meaning it is not backed by specific collateral. While its returns are linked to the performance of an underlying index, investors bear the credit risk of the issuing bank, meaning if the issuer defaults, the investor could lose their principal. For example, if a bank issues an ETN tied to a commodity index, its value will track the index, but if the issuing bank goes bankrupt, the investor could lose their investment even if the commodity index performs well. Always remember that ETNs carry issuer credit risk in addition to market risk. Question 15. Which of the following accounts typically has a trustee who manages the assets for the benefit of a beneficiary? A. A cash account. B. A margin account. C. A trust account. D. An individual retirement account, IRA. Answer: C. A trust account. A trust account is a legal arrangement where a grantor, the creator of the trust, places assets under the control of a trustee for the benefit of a named beneficiary. The trustee has a fiduciary duty to manage the assets according to the terms of the trust agreement and in the best interest of the beneficiary. For example, a grandparent might set up a trust account with a trustee to manage funds for a grandchild's college education. The trustee plays a crucial role in overseeing the assets and distributing them as specified. Question 16. The Securities Investor Protection Corporation, SIPC, protects customer accounts against which of the following? A. Losses due to fluctuations in the market value of securities. B. Fraudulent activities committed by the brokerage firm. C. The failure of a broker-dealer, up to certain limits. D. Investment losses caused by a registered representative's poor recommendations. Answer: C. The failure of a broker-dealer, up to certain limits. The Securities Investor Protection Corporation, SIPC, is a non-profit organization that protects customers of brokerage firms in the event of the firm's financial failure, up to a maximum of $500,000 per customer, including up to $250,000 in cash. SIPC does not protect against market losses or poor investment decisions, but rather ensures that customer assets held at a bankrupt broker-dealer are returned to them. Think of SIPC as similar to FDIC insurance for bank deposits, providing a safety net against broker-dealer insolvency. Question 17. In a primary offering, a group of broker-dealers who collectively assist in the distribution of a new issue of securities is known as A. A tender offer committee. B. A stock exchange. C. An underwriting syndicate. D. A mutual fund. Answer: C. An underwriting syndicate. An underwriting syndicate is a temporary group of investment banks or broker-dealers formed to underwrite and distribute a new issue of securities to the public in a primary offering. The syndicate members share the responsibility, risk, and profits from selling the new securities. For example, when a large company decides to go public, several investment banks might form a syndicate to collectively help sell millions of shares to investors. This collaboration allows for more efficient distribution and risk sharing among the participating firms. Question 18. Which of the following statements is true regarding municipal bonds? A. The interest income from municipal bonds is always federally taxable. B. Municipal bonds are generally considered riskier than corporate bonds. C. The interest income from municipal bonds is often exempt from federal income tax. D. Municipal bonds are typically issued by corporations to raise capital. Answer: C. The interest income from municipal bonds is often exempt from federal income tax. Municipal bonds are debt securities issued by state and local governments and their agencies to finance public projects, such as roads, schools, or hospitals. A key attractive feature of municipal bonds is that the interest income they generate is often exempt from federal income tax, and sometimes from state and local taxes if the bondholder resides in the issuing state. This tax-exempt status makes them particularly appealing to investors in higher tax brackets. Always remember that municipal bonds offer a tax advantage on their interest income. Question 19. A registered representative repeatedly executes transactions in a customer's account that are excessive in size or frequency, given the customer's investment objectives. This prohibited practice is known as A. Market manipulation. B. Churning. C. Front-running. D. Free riding. Answer: B. Churning. Churning occurs when a registered representative excessively trades in a customer's account primarily to generate commissions rather than to achieve the customer's investment objectives. This practice is unethical and illegal because it exploits the customer's trust and generates unnecessary costs. For example, if an RR makes 20 trades in a conservative investor's account within a month, it might be an indication of churning. Remember that an RR's duty is always to act in the best interest of the customer, not to maximize their own commissions. Question 20. Regular way settlement for corporate equities and municipal bonds typically occurs on which day? A. Trade date, T. B. Trade date plus 1 business day, T plus 1. C. Trade date plus 2 business days, T plus 2. D. Trade date plus 3 business days, T plus 3. Answer: C. Trade date plus 2 business days, T plus 2. Regular way settlement refers to the standard time frame for the buyer and seller of securities to fulfill their obligations by exchanging cash for securities. For most corporate equities, corporate bonds, and municipal bonds, regular way settlement occurs on the second business day following the trade date, T plus 2. This means if you buy a stock on Monday, you will pay for it and receive ownership of the shares on Wednesday. Conversely, government securities and options generally settle on T plus 1. Question 21. What is the primary purpose of Form U4, which must be completed by individuals registering with a FINRA member firm? A. To report customer complaints against the individual. B. To apply for a securities license and disclose employment history and disciplinary actions. C. To terminate an individual's registration with a firm. D. To record continuing education requirements for registered representatives. Answer: B. To apply for a securities license and disclose employment history and disciplinary actions. Form U4, Uniform Application for Securities Industry Registration or Transfer, is a critical document that an individual must complete when applying for registration with a FINRA member firm or transferring their registration to another firm. This form collects extensive personal information, employment history, residential history, and most importantly, requires disclosure of any past disciplinary actions, criminal offenses, or bankruptcies. The information on Form U4 is used by FINRA to determine if the individual is qualified and fit to be registered in the securities industry. Think of the U4 as your comprehensive resume and background check for the securities world. Question 22. An American Depositary Receipt, ADR, represents ownership in A. A basket of domestic stocks traded on a foreign exchange. B. A foreign company's shares, held in a U.S. bank. C. A U.S. company's shares, held in a foreign bank. D. A bond issued by a foreign government. Answer: B. A foreign company's shares, held in a U.S. bank. An American Depositary Receipt, ADR, is a certificate issued by a U.S. bank that represents a specified number of shares of a foreign company's stock. ADRs trade on U.S. stock exchanges like domestic securities, making it easier for U.S. investors to invest in foreign companies without having to deal with foreign currency conversions or international custodians. For example, if you want to invest in a major European car manufacturer, you might buy its ADR on the NYSE rather than buying the actual shares on a European exchange. ADRs simplify investing in foreign companies for U.S. investors. Question 23. What does an inverted yield curve typically suggest about the economy? A. It predicts strong economic growth and rising inflation. B. It suggests that short-term interest rates are lower than long-term interest rates, indicating investor optimism. C. It indicates that short-term interest rates are higher than long-term interest rates, often preceding a recession. D. It implies a stable economic outlook with moderate inflation. Answer: C. It indicates that short-term interest rates are higher than long-term interest rates, often preceding a recession. A yield curve plots the yields of bonds with equal credit quality but differing maturity dates. An inverted yield curve occurs when short-term interest rates are higher than long-term interest rates, meaning investors demand less compensation for lending money for longer periods. This unusual phenomenon often signals that investors expect economic growth to slow down significantly or even enter a recession in the near future, leading the Federal Reserve to potentially lower rates down the road. Historically, inverted yield curves have been reliable indicators of impending economic contractions. Question 24. Which of the following retirement plans is typically established by employers and must comply with specific rules under the Employee Retirement Income Security Act, ERISA? A. Individual retirement accounts, IRAs. B. Roth IRAs. C. Qualified plans, such as 401(k)(s). D. Non-qualified plans, such as deferred compensation plans. Answer: C. Qualified plans, such as 401(k)(s). Qualified retirement plans, like 401(k)(s), 403(b)(s), and defined benefit plans, are established by employers and must meet specific requirements set forth by the Employee Retirement Income Security Act, ERISA, of 1974. ERISA mandates rules for participation, funding, vesting, and fiduciaries to protect employees' retirement savings. For instance, these plans typically allow pre-tax contributions and tax-deferred growth. In contrast, IRAs are individual plans, and non-qualified plans do not have the same ERISA protections. Question 25. A registered representative makes a recommendation to a customer based solely on the customer's age. This action violates which FINRA rule? A. Communications with the public rule. B. Anti-money laundering rule. C. Suitability rule. D. Know your customer, KYC, rule. Answer: C. Suitability rule. The FINRA suitability rule requires registered representatives to have a reasonable basis for believing that a recommended transaction or investment strategy is suitable for the customer. This assessment must be based on an understanding of the customer's investment profile, which includes, but is not limited to, age, financial situation, investment experience, investment objectives, and risk tolerance. Making a recommendation based solely on age is an inadequate and potentially harmful oversimplification that fails to meet the comprehensive requirements of suitability. Always remember that suitability demands a holistic view of the customer's financial picture, not just one factor.